Do you want to capitalise on the projected growth opportunities in Brisbane? Streamline Property Buyers are your local area experts with a qualified property investment advisor, licensed builder and rent specialist, making them the most qualified buyers agents in Brisbane. This team know Brisbane property better than anyone else. Find out more at streamlineproperty.com.au.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi everyone, how you going? Thanks for joining us on the podcast today, and thanks also for all those reviews coming through iTunes. We do check them out every single day, and we do appreciate the feedback, and very conscious of feedback. We always look to try and shape the show with the needs of you, our audience, and I think we're doing a pretty good job, but I'm always looking to improve it. Some of the feedback I've been getting recently is that you want us to dig down into people's property portfolios a little bit more. We used to do a lot more of it back in the day, and we're starting to do a little bit more of it now. But if you're involved and you're in property and you want to come and share your portfolio with us, please do. You can contact the team editor at smartpropertyinvestment.com.au. Whether it's one property or 50 properties, we want you in. But today, I've got someone that's going to share his property portfolio. You might know him. He occasionally is on the show with me, Alex Whitlock, who I invest with within the Smart Property Investment portfolio, which you've all been tracking for many, many years now. If you want to go and have a look, smartpropertyinvestment.com.au, just click on our portfolio and you can see what we're doing collectively. But Alex is also building out his own property portfolio individually, as am I. And I've got him to come on and share what he's been up to with this particular portfolio. And he's brought his buyer's agent along with him, Paul Glossop. Gentlemen, how you going? This is going to be a good chat. Are you well?
Yeah, good, Phil. Yeah, thanks for having us on.
Oh, I've got a list here. This is the best brief I've ever seen in my life, Paul, around facts and figures with property. And maybe if Alex, you're all right with this, we can stick this up online and share it. But
happy to do that.
I don't want this to be me talking about this and trying to generate a conversation with you guys. I know you're pretty close. You've bought from the list here quite a lot of properties together. So I wanted to open up this chat to you guys and actually have a bit of a conversation around maybe sharing, reminiscing on what you used to do and how you're going to do it moving forward.
Yeah, no, thanks, Phil. Look, thanks for having us on the show. Look, you and I have invested in property for quite some years now, and there's a couple of goals for that. We've been in business for a long time, so it was a joint venture in terms of investing and exploring and understanding how investment works and getting it right. It's also very important for us together to showcase exactly how to invest, warts and all. But aside from that, we've both got our own, objectives. So, I'm a little bit older than you, 52 years old now, sort of getting to a point now where I want to sort of think about maybe some sort of exit strategy for my own very expensive mortgage I've got in my house, maybe opening up some options further down the track. So that was really the genesis of going into, aside from what we do together jointly, is sort of building my own little nest egg, my own little portfolio.
And to that point also, that's diversification as well, right? It's another layer of diversification.
These are quite different assets to sort of what you and I have invested in jointly.
So when did you start this journey?
Well, you could say that I started this journey really probably back in 1998 when I bought my first investment property, because I've had investments outside of our joint portfolio for quite a long time. And that has been used, and I won't go through that, I've talked about it before on the podcast, but that's been used in various formats to secure my first home, to also maintain a small portfolio going forward, which has sort of grown. I've been able to leverage off equity. So that's kind of run concurrent with what we've done. So a small legacy of that, what I had remaining from my investment portfolio, I worked with Paul to start really, sort of a few years ago, probably about 3 years ago, Paul?
Yeah, pretty much bang on.
Building up just a renewed portfolio with a renewed target and a renewed goal for sort of a shorter time frame. So really, we were looking at sort of a 10-ish year time frame, and that sort of evolved over the last couple of years.
So you're probably familiar with Paul, who's been on the podcast before. We did a really good live stream a couple of weeks ago now, I think, now on Hotspots, or whether there is such a thing. So go and check that out. It's on smartpropertyinvestment.com.au. It's about an hour discussion, plenty of meat in there. But Paul, pure property investment.
Yep.
Is he a good client, Alex Whitlock?
He actually probably, in the grand scheme of things, is. There's definitely some things that look with a smirk on your face. I think everyone's always got their things that
you don't want to be the perfect. Listen, you don't want to be the perfect client.
No,
it means you're too soft.
There is no perfect.
You
client.
Want to be a little bit of a pain in the ass.
I actually personally get a little bit nervous when a client probably is a little bit more too laissez-faire about just do what you're going to do. That was back in uni days there, that we had the 3 categories, PHPE days. That was where that came from, just as everyone else was curious there. But yeah, look, I think ultimately, clients-wise and the way Alex works, and I think the way we work well together is we set a very clear brief initially, but the key with setting a brief, I think from an objectives and strategy position, is it has to be reviewed regularly. And the key, and when we go through these numbers, is one thing that's very obvious is over the last 1, 2, 3 years, things have evolved, changed in your life personally, financially, and it's made us have to make changes within this portfolio, but it's still intact, and that's the key.
I think why this relationship works, just with you and I, is first of all, you have to start from somewhere. So you start out by saying sort of what is your goals, and I told you what I was looking to achieve. You understood that, and we started building the portfolio around those particular goals. And we've stayed true to that largely, but it has evolved as markets have changed. There have been some areas of opportunity, there's been some areas of change and some areas of decline. So we've kind of, sort of evolved it. But I think starting from scratch, knowing kind of where you're going, you understood that, and we bought initially around that particular goal. And I have to say those initial properties have, we'll go through the portfolio in a moment, but, they've gone very well and they've gone to plan.
Yeah, absolutely. And I think that's probably in the backdrop of probably more of a national market that probably hasn't performed the same way that when we did kick this off, that it performed the 3 years prior. So there's a few things there that we'll look at as this was bought, and the other things manifested their way through.
So we'll get into the properties in a moment, but we're going to talk about strategy and I guess the philosophy of how you've approached this relationship. So you know what Alex is trying to achieve, and it's your job to deliver on that with the identification of the right assets to achieve it. What's the sort of guiding rules for how you guys go about doing this? Is it, are you focusing on high growth properties, capital growth properties, yield properties? Is it a mixed bag? What's the basis of it all?
Yeah, and when we first had that discussion, and these were the questions that we wanted to figure out, is what is the current assets liabilities position? What's the current overall income? What's the available surplus income? And what do these properties have to do? And what's our time frame that we have to hold this true to? And Alex just outlined there that we had roughly around about a 10, 15-year time frame when we first kicked this off. That's probably changed a little bit over the time. Yeah. But as part of that is, as much as there might have been a surplus income, there was also the intention of buying or upgrading the principal place of residence, which also meant there was going to be extra money needed at certain points in time to tip into that non-deductible, non-income producing asset.
And that was really around, based when we first sort of looked at this strategy, it was really about building. I mean, I've got a $2 million mortgage on my principal place of residence, which is a huge amount of money. That frightens and daunts me. So, but rather than thinking my age, I will save extra money and pay it off, I've looked to build a contingency plan and work with Paul saying, okay, let's build a pool of assets so that at some point in the future, 10, 12 years, whenever, we can build enough equity in that particular asset pool, and that will then go to either, if not paying off the entire mortgage, certainly putting a pretty sizable dent into it. That's how we started out. It has evolved a little bit since then, but that was where we started out.
Absolutely. And that was sort of created also on the backdrop of trying to figure out how we can keep building it, but not necessarily take away cash flow that is necessary for you to then tip that into the mortgage, because ultimately that's where we wanted to say we still got to try and figure out how do we keep this somewhat cash flow neutral while still building the portfolio.
It's also important to point out that myself and Phil have a joint portfolio, which that sits isolated, and we treat our portfolio with significant discipline, and discipline is very, very critical in terms of investment. So I want to make sure that I'm not looking towards mine and Phil's investment strategy and starting to sort of think about needing to dip into that for my own personal goals. So this was very strategic from me to make sure we can continue down that path, and that will go where it's going to go. This is really about, sort of my own personal journey and do my own personal thing.
So the overall objective in building out this portfolio, Alex, is it's just an enabler for you. So at a point in time, if you build it out correctly, you've got a choice to sell it off, pay off a mortgage. But if you don't need to do that, then you have a different asset pool.
There is another angle. I absolutely love investing in property. I know it sounds really...
What do you love about it, though? Like people always say they love investing in property. What do you love about it?
I love it because it is so accessible to everybody. I'm not the world's most educated person. I'm reasonably smart. I'm not, super bright. But I just love the fact that with property, if you learn discipline with investing in property. And I think knowing where you're going, having discipline, having a reasonable measure of risk versus return, understanding, the identifying factors of greed. I think these things, and then applying that to property where I've worked with Paul, and Paul's done a great job. We worked, there's one property where I said, I want to buy in this particular area, and Paul went away and found the asset. Paul's also recommended areas to buy, but I just love the whole concept of being able to create a better financial future through something so tangible and accessible for everybody. So I just like tinkering.
I think you're fortunate, Alex, because it takes some people a long time to actually work that out. And the best property investors I see is people actually understand why they're doing it outside of just commercial gains. But it comes down to portfolio makeup, portfolio construction, and why you're doing it. And when we come back from this break, we're going to get right into that. We're back in a moment.
Worried about making the wrong choice with your next investment? You're not alone. If you truly want to become the master of your own lifestyle design through real estate, then you need to speak with Dash Buyers Agents, who'll help you acquire cash flow positive properties in high growth areas with value add potential, so you can create more freedom in your life. Visit dash.com.au/SPI.
Welcome back, everyone. Here with Alex Whitlock and Paul Glossop. We're chatting about Alex's property portfolio. It's a considerably sized portfolio. It's not massive, but it's not small. And from what I understand, you want to hear about exactly how we've built this out, or how Paul and Alex have built this out. Let's kick off from the start, Paul. There's a property in Mango Hill, first asset that you've secured as part of Alex's purchases. In my sheet of paper here, and thank you so much for the brief, the objective of this was future developments or subdivision.
Yeah, and again, going back to our original brief here, was looking at a strategy that was going to allow us for growth over probably a 10, 12-year play, with the intention of some of these assets were going to be probably properties that were going to be sold down intentionally, and some of them were going to be ones that we'd ideally be able to potentially retain, with a combination of then taking that profit, redistribute it, pay off that principal place of residence debt. So that property was at a time when that market was probably at its very much its flattest, very little attention in that market at that time. Larger block, double block, in the sense that it has a existing house on it, opportunity for actually two separate properties to be built on that property, but it was an updated asset which was very, very much in an owner-occupier centric location. Decent rental yield, not outstanding, was probably around about 4.5% yield, but really the intention here was a really good growth asset with a development upside, with a property that probably didn't require much, if any, money to be tipped into it for the short to medium term. That property's been the portfolio for the best part of 2.5 odd years now. Yeah. And it's probably just below cash flow neutral, I would say, based on the current rates.
That's right.
And we've probably seen, we purchased that property at a $390 purchase price about 2.5 years ago. Current market value, if it was sold on the market right now, based on what it actually can achieve, is probably somewhere between that 430 and 440 mark, realistically. So there's a slight uptick in growth there. But again, the intention of this property in that market, we probably see the next 5 years is looking very attractive.
And again, it's really important to say that for my particular goals with this particular portfolio, is a longer term strategy. It wasn't sort of looking for, to tap into a big uptick in terms of capital growth, or looking at tapping into sort of particularly high yields. It was really with that long term strategy in mind.
Yeah, and quite a balanced property.
Yeah, being conscious of time, and it's quite a lot to go through here today. So just to frame this conversation, we'll go through these in different assets. What do you like about this property?
Yep.
What makes you a little bit nervous about it?
What I really liked about it is the fact that you've got a built-in opportunity with an upside. So double block, opportunity for a development upside, and or a granny flat if it was as simple as that. But predominantly, overarchingly, it's still a good owner-occupied property in a very strong owner-occupier area. So if you never choose to develop it and never choose to do anything to it, there is going to be much more demand in there for owner-occupiers than anything else. And that's what's going to push that consistent growth on this asset. And it was more or less cash flow neutral. So fit the brief from a cash flow perspective, owner-occupier perspective, as well as future upside and development upside as well.
Okay. Potential challenges with it?
Look, I think the yield initially was probably a bit short of what I would have personally liked it to be, and it's a little bit of a smaller house. So the challenges with it, potentially the objections for any potential future buyers, is the house itself is only a 3-bedder. That area is dominated by families with 2 kids. So you kind of look at where you might get that objection for certain potential future buyers to say the house is a bit small, or future renters saying the house is a bit small for their requirements.
Okay, and moving right along, still in Queensland, next asset was in Kalunga. I got a couple of properties up there. I think it's great.
Yep.
It's right near the new Sunshine Coast University campus, and that's right now. And I look at the objective of this. You've said capital growth with granny flat upside.
Yeah, absolutely. And walking distance. So this property was bought about 2 years ago now. It was a property, actually, I know this property very well because I know we were looking at it around about a $345 purchase price initially. It didn't sell. At that time, it was much more of a flat market again, and we ended up grabbing that property for $310. Renting, it's slightly cash flow positive from the numbers we're looking at. I think it's renting around about $350, $360 a week from memory. So yield is quite sound on the property. Decent sized block, but walking distance to that Petrie University campus, and actually a decent quality property again as well in itself. So purchase price is $310, market value, it would probably sell for about $375 in the market right now. So decent uptick in growth, but really quite neutral as far as cash flow is concerned. And on top of that, we've got that upside. So as and when that university comes online, which is now only about probably 6 months away from it actually opening the doors for first enrolments, you're looking at an area there which will, and I talk about granny flats in pros and cons, but the pros of this market is you've got a ready-made market for that 1 and 2 bedroom accommodation. So it may well be one of those properties which we hold for the long term, get some extra cash flow and just let that one bubble away in the background, or alternatively still good owner-occupier area, quiet street, walking distance to amenity, good cash flow to start with and probably at the right time in its cycle.
Any downsides?
Look, it's a bit of an older property, so you're probably talking about 35 years old circa. So there is, with those properties, it wasn't necessarily fully renovated. So you are going to have your tinkering, your annuals, probably 1% of purchase price, which will come up from time to time, hot water heaters, basics. So that's probably your downside, which you will require maintenance
Potential
long-term.
maintenance in the future.
But it is something you budget for.
So it's clear to me, Alex, that Paul's very familiar about these assets, and it's part of his job as a buyer's agent is finding these based on your strategy. What's your connection with these properties? Have you seen them? Like, do you just take Paul's word on it that it's right for you? How do you frame that?
Yeah, for these two, I haven't visited these two properties. I have visited other properties in this portfolio, which we'll get to in a little bit. But for these ones here, because these were fairly straight, if I could look at this on an Excel spreadsheet, I understand the numbers that Paul's put forward. I understand the numbers that Paul's put forward. So for me, I didn't really feel I needed to go and view them and visit them. I'm reasonably familiar with, the economic factors that are driving growth in those particular areas. So, yeah, happy to have those set and forget.
Okay, and these next couple of assets you purchased?
So the next one's sort of different. Again, myself and my wife went down to Tassie for the first time, which I thoroughly enjoyed in early 2017. Came back, bumped into Paul, who's coming to do a podcast. Obviously, Paul made a couple of acquisitions for me, sort of prior. And I had a bit of a look at Tasmania just from having gone there, had a look at some of the factors that were sort of impacting growth and saw that Hobart just had a certain feel about it that I just smelt that it was something was happening there. So I had a chat with Paul and said, look, I'm really quite interested in Hobart. Paul said, I'm just starting to buy a few places in Hobart. So within about 35 seconds, I said, okay, look, let's go and get something.
Yeah.
And you went straight ahead. And
So on my notes say capital growth with sound cash flow, good size block, etc.
Yep.
You've sold this property, have you?
I have.
Yeah. And that's the interesting part about this asset. And I think this is what that regular catch up and how each property has to fit, but also saying that whatever you set out, don't think that is your set in stone strategy because things change. And
yeah, this was opportunistic in many
massively,
ways.
yeah. And I think reflecting on that conversation, probably a couple of years back, we probably ended up buying maybe 100 odd properties in that Hobart region over about a year and a half period between late 2015 through to early 2017. And that was a market which, to your point, Alex, at that stage we saw that was minimal vacancy, absolutely no supply coming to that, a rapidly improving economy and a market that was probably very undervalued and had gone sideways, if not backwards, for the best part of a decade. Yep. All those things really, they culminated into an opportunity market, and that property at that time fit into what our objectives were. Was the intention of this property, to be fair, wasn't to sell it.
No,
it was never to sell it. It was to buy it. Really good cash flow. It was about close to 7% at the time we were getting on the property.
Right.
Well, it says here it's positive cash flow, 3,500 per
It was
annum,
bringing
right?
in,
It's not
I
bad money.
believe, it was 370, 380 a week at the time. We ended up being a vacant possession, but that was really where it was. On a $264,000 purchase price, it was bringing in really strong yield and relatively low holding costs on a good quality corner block with pretty much no maintenance on that asset as well. But the intention here was to buy it, ideally, good cash flow from day one. Let's look at this as a long-term hold and residual income. But that led into two things, one of which is the market probably performed. And look, I'm always happy when properties or markets perform better than what we would assume, but it rapidly grew in value. And pretty much all of those properties in that sub $3-ish $100,000 mark in that area really went exponential for a couple of years.
I'm happy with the performance of the initial investments as per the script that Paul and I had sort of worked on. This was a bit of a, like I say, it was just a coincidental, opportunistic, and the thing just went ballistic. So, and we'll come to that in a little bit because I have just recently sold that. But
how much did you make out of that sale?
Oh, it was about 65,000.
Okay.
In a very short space of
it's
time.
Not bad over 18 months.
With a cash
net.
positive.
Yeah. So that property basically
was that after like agent fees and all that sort of
in
stuff?
and out. Yep. Yeah. In and out. That's about the margin after all said and done.
Can't complain about it considering you're putting your $3,500 in your back pocket.
When you're talking about what the actual percentage of purchase price was, it was probably the best part of about 35-40% on the purchase price, but cash on cash return, it was probably pretty close to 100% in a 18-month period, cash on cash return.
And this just for me personally, every investor has their own, sort of set of rules they want to go by. But for me personally, the way that I'm wired, I have a strategy, but I'm always willing to look and adapt and change that strategy based on, environmental things around me, and then also based around things that are happening in terms of property market where I believe there are other opportunities. So that was definitely a part of a set and forget, but things changed. We'll chat about that.
Well, that's balance between, and probably conclude the chat with this, but that's balance between strategy and being pragmatic, right?
Yeah.
We'll get to that in a moment. All right, so the next property. Oh, it looks like it's two properties
Yes,
up in
joined by,
Deception Bay. Paul, where's Deception Bay?
So Moreton Bay Peninsula, towards the back end of the Moreton Bay Peninsula, at the actual end part of it. So we're talking on the east, so where we're talking the northeast side of the Moreton Bay Peninsula, essentially adjacent to Kippering and Newport, up in that area. Probably what I would deem to be Deception Bay, and the strategy for that one for us was recently rezoned markets. In particular, we weren't necessarily looking at that whole area as a general, but it was more so this was a long-term growth play that had half decent cash flow, but it was definitely a lower socioeconomic and still is a relatively lower socioeconomic area, which we deem to be a market which is definitely a slower burn, but has the upside where there is going to be minimal of opportunity of supply for those types of assets that had been rezoned to effectively a high density market, which for us is to say that this property is not necessarily going to be a development that Alex is going to take on, but it's a property that's going to be attractive for a developer potentially in the years to come,
So is
with
this a
neutral cash flow.
Gentrification objective?
This is kind of a bit of a pump with a hedge. So as Paul, for those of you that know Deception Bay, there is great potential there, but the reality is it's a pretty interesting market. It's, you end up struggling to get good tenants in there.
Yep.
I've had some challenges with those properties, which, may get a chance to go into, maybe not. But it's really about, as Paul said, the zoning's changed there. There is potential for big upside in terms of developments. And as Paul said, whether I develop it myself or I sell it on to someone else who's looking to take that opportunity forward, it is bolstered by a fairly reasonable level of cash flow. So the risk is mitigated by, it's kind of just a bit below cash neutral.
Yeah. So, I mean, from my point, that fits that, where you could go and drop, we pick those up for a touch over 600,000 combined, with about 20 metres frontage, a bit over 800 square metres, not necessarily a huge block of dirt combined, but it did give you the opportunity to say that is a development upside or a development ready asset if and when you chose for it to be. So it was pretty much dead flat block, no easements, you could do it. And there's already some markets or properties around there that are starting to go through DA application for higher density units, townhouse development sites. But at that point, I actually say, well, if we're going to utilise $600,000, what else could be done with that? And what would the outcome be for 600 grand in any market in this country if it wasn't to be those two assets? The options were to say we could chase probably more rapid capital growth with lower cash flow, but that fed into what is the overall objective here. You've still got a $2 million mortgage on your principal place of residence. And that last property, which we'll get to in a second, is there was also an intention to maybe look at a downsizer property, which was going to be a higher price point, which also meant that we had to be somewhat strategic in what that property has to deliver as we said, maybe a bit of a punt with a hedge. And the hedge is that it's not going to bleed you dry of cash. If it doesn't come out, then we walk away from it, maybe cash flow neutral, but it's going to allow you to get to the point of maybe getting that upgrade or downgrade.
Well, this next property looks like it's very different than the other assets here. And when we come back from this break, we'll reveal where that was.
We get it. You're here listening to the Smart Property Investment Show, and you're being interrupted by this ad. We value your ears just as much as your eyeballs, so we'll be quick. Join passionate property investors on Facebook today and we'll fill your Facebook feed with useful tips and tools, plus free education from industry experts and a tribe of people who get it. Passionate property investors. Find us on Facebook now.
Welcome back, everyone, here with Alex Whitlock and Paul Glossop. The most recent purchase, Alex, here in your portfolio. Interesting.
Yeah. Not
in Queensland, not in Tasmania. It's in New South Wales. It's in Sydney. It's a very different asset. Why? Where was it? Where is it?
So I've purchased a unit in Newport, which is on the northern beaches, sort of midway up. It's before you sort of get off the beaten track and end up, on the single carriage road that goes all the way up to...
Is it before the bends or after the bends?
No, it's just before.
Just before the bends.
It's kind of it's just up from Mona Vale if you know the area. So you're still on that sort of 2 to 3 carriageway highway. It kind of goes to single carriageway when you hit Newport. So it's still pretty quick and easy to get to from the city. So, but the why... Number of things. I'd look all the time. I get excited about opportunity, and I look and see what's happening, sort of around us. We've had this really quite, interesting sort of 18, sort of 24, maybe 36 months where the markets, particularly in New South Wales, particularly in Sydney, have come off. You've had the backdrop also where interest rates have just been, sort of just going down fairly steadily. We've had the impact of the Royal Commission around the property market. You've also had the changing of government where you've looked at the prospect of negative gearing
going. A lot of uncertainty.
So what that's created, I just feel that in that particular suburb, looking at sort of ocean-facing properties, which are, just pure gold, there's so few of them, you can't increase those views. I thought there's a chance now, probably a gap in the market to buy something with an ocean view. Also running in concurrent with that, it's a kind of a bit of a retirement strategy. So looking at some point or other, having a property where, look, I'm not probably going to live in it, but It might be something to use during the midweek when I am retired, semi-retired, so I'm going to spend some time with my wife and family.
Can you, if you're investing in property, Paul, you set yourself with a strategy. Can you have multiple strategies within the sort of wider strategy? Because, looking at this portfolio makeup here, you're talking about these Deception Bay properties. It's a pump with a hedge.
Yep.
It's sort of connected with this long-term capital growth, but there's some other plays as part of it where if you are pragmatic, you can look at it. And this property here in Newport is very different again, right? This is about maybe a little bit of retirement, maybe the lifestyle benefits. Let's just see what happens, right? But it still comes down to the actual asset itself, and you need to buy well.
Absolutely. And I think the biggest thing here as part of this overall strategy and how this property fit in here is the backdrop of the uncertainty of the last 18 months, particularly in the finance front. And going back to the rationale of selling the Hobart asset was finance is difficult to attain. Alex had built up a sizable portfolio of his own. He also is part owner of a separate portfolio, which all comes down to when a mortgage broker or a bank's looking at how do we access funds, is they need to figure out how you're going to balance the sheets here and how you're going to actually get that credit. And part of this is we saw that we could either try to take equity out of that Hobart property, or is it a time where we're seeing it's probably maximise its value, and do we take that money off the top and then recycle it into getting this negatively geared, more of a growth asset, and then how does that rebalance a portfolio? Now, we look at the numbers right across that portfolio, we're probably only going to be negatively geared by somewhere between $5,000 and $7,000 pre-tax, commanding a pretty large property portfolio here, and that's combined with set and forget assets, future development assets, growth assets, and then straight up probably really just blue chip assets, which is the last one that we picked up here with a slight owner-occupier or usability side of things, and then a time in the cycle.
So it's worked a little bit differently with Paul and his team with this particular purchase. So initially, our sights were set on Manly, which is a market that I don't know particularly well, and it's not really necessarily Paul's area of expertise, but he went about his usual strategy as a buyer's agent, sort of contact agents. We looked at a couple of places in Manly, but this particular, I found this property on realestate.com. So I went to Paul and I said, look, I found this place here. It's a little bit out of the brief that I've given you. Paul and his team, so I looked at it, I liked it. My gut feel was that it was a good buy. It was priced, there wasn't really it was going to go to auction. I knew it had sold for a few years ago. But for me, even though I liked it, my gut feel felt good, I didn't know what the right price was to pay for it to get a good deal. So I worked with Paul and his team. They dug deep into this property. They looked at all facets looked deep into strata. They got an analysis of the surrounding properties, sort of modelled up what the potential for growth was. So although I'd found it, Paul's team dealt with the agent, made the purchase, and managed that all the way through, but gave me the security that I was actually making a smart and sensible investment.
So why didn't you go alone? Like you're skilled, you're knowledgeable about property, you know what you're doing. You're probably led by your gut rather than the numbers. But what to actually, it costs money to use, Paul. So why did you?
So there's two reasons. One of them is I genuinely don't have the toolkit to really know what that walkaway price is. And even though it's quite painful, it's like getting somebody to pull a splinter out, Even though it's quite painful, I wanted somebody to say, we pull the pin here. And I left that with Paul and his team. And it kind of, even though there isn't time to talk about, we failed at auction already down in Mona Vale, and we walked away.
We looked at some off markets as well,
and
that was more expensive.
Absolutely dodged a bullet with that one, But anyway, so I wanted somebody to pull the splinter for me. And in this instance, it was Paul and his colleague Lena. The second thing is, there is so much that it's apart from a gut feel and apart from the sunshine, I'm going to see the sea. There is other data that needs to be considered in whether this is a good purchase or not. And that's really where Paul's team, they dig so deep and they unveiled things that I would never have looked into. And they're just experienced in buying unit after unit after unit. Even though it's a nice unit on the beachfront, it's still a unit. There are still fundamentals that make this a good investment or a bad investment.
We've only just touched the tip of the iceberg with this conversation. I really appreciate you guys coming and have a discussion. Look, we've gone into the properties. We could probably dig a little bit deeper. And Alex, let's get that
before we round off. So this particular one here, we, again, looking at price, this sold in 2016, 2017-ish it was about 1.3 million or something like that.
Yep.
And you and your team secured it for
119.
Yeah.
So we call it 10% off the top of when it was probably peaking, or maybe went up slightly after it sold, but then probably came off the top there as well. But I think one of the things in particular on this property, yield's going to be, as we said, probably about $7,000 to $8,000 a year negative. Cash flow is relatively soft, but as far as what the asset is, and I feel there's additional things with this particular property: ground floor, garden apartment, 2-car parking on the beach with unobstructed views, can't be built out. Then we look at saying, well, on top of that, the property was potentially also under-resourced in the sense that it had garden views and literally its own access to garden, but didn't necessarily have it except for through the master bedroom, which for me is, yes, that's fine, but that's also an opportunity in this particular property, which might not be something you choose to do now, but down the track, there's an opportunity to open this property up straight onto a garden through a wall that it currently exists. And that in this property, if that existed right there and then, having exclusive garden access, ocean views in that particular pocket would turn this from a $1.19 million property probably more so into that 1.314 very quickly again as well.
Yeah, I think the opportunity is to, I want to dig down into this a little bit more. I think there's a lot of themes we can extract out of this. We haven't really touched about on financing as well.
Yeah, don't. By the skin of my teeth.
But if you don't mind, Paul, let's come back and maybe let's crunch these a little bit further. And, we haven't even looked at how you manage these properties.
We're just coming up for settlement. Maybe let's catch up once tenants are in. And I enjoy being invited on the show. Love talking about property. Anything that I do, absolutely wide open. So I'm happy to share everything that I'm doing. And probably look a little bit more at the Deception Bay ones. They've not gone so well. I'm happy to open up and talk about that.
I think let's do it. And look, get involved as well. If you've got any questions around this particular portfolio, Alex will reveal warts and all what's going on, and that's a very good thing. I think it's the only way we can all learn as property investors how other people are doing it really well, but also where they are making those mistakes. And it's something that's been passionate for me and Alex over the many years we've been running Smart Property Investment. Look, we're very clear on where we could do it better, but we're also happy to share our successes so you can as well. Email the team, editor@smartpropertyinvestment.com.au. Any questions, we'll answer them, no problem at all. I know Paul's happy to do some Q&A type stuff as well.
As always, yeah. And if people want to get in contact with us, they can reach out to me personally at purepropertyinvestment.com. They can also email us directly at inquiry@purepropertyinvestment.com if they've got any questions about this portfolio and how we've worked with Alex in previous scenarios as well.
Okay, nice one. Gents, thanks for joining me today. Really good. Remember to check out smartpropertyinvestment.com.au if you're not yet subscribing to our daily morning newsletter. So the first to know what's happening in property right across Australia, smartpropertyinvestment.com.au/subscribe. And I always get asked how you can help us here on the Smart Property Investment Show. The one way you really can support us is keep those reviews coming on iTunes or wherever you are listening to this podcast. It's just not me here sitting behind the microphone talking. We've got a great team here who produce this, and they get a real kick out of the feedback that we're getting. So please send those reviews through, and we're happy to change and evolve it in line with what you need. So reach out, get in touch. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
If you're a regular listener to the Smart Property Investment Show, then odds are you're already a property fanatic who loves hearing stories on investing from real people. The good, the bad and the ugly. Be with people just like you and join the group Passionate Property Investors on Facebook now. Become part of a community who know what to do and when to do it. And the time to do it is now. Passionate Property Investors. Tribe, tools and tips. Find us on Facebook today.